Hello everyone, welcome to TradesByAdvait YouTube channel, and today markets are at a very pivotal point in the course of its bull run. So it's a very heavy inflection point, and we are only few days apart from the Trump's inauguration in the White House, and so far 2025 has started with a modest digestion, and the future outlooks for stocks is in the fate of federal policies and a lot of macro challenges that we have. So I'm going to discuss all the future opportunities and future outlook for the capital markets with the macro analysis and of course technical analysis in detail in this video. So stay tuned and let's jump right into the analysis, starting with the macroeconomic update. So in this section, the first thing that I want to discuss is the 10-year yield, which is sitting at 4.6%. Now, historically speaking, the 10-year yield is at 4.6%, which means it is way higher than its usual normal average. So let me show you what do I mean over here in charts. So basically, this is the weekly chart of the 10-year yield, government treasury note. So you can see over here that since the start of 2023, it was consolidating over here, and then it went really high around 5%, and then it is right now trading in the downward channel. But what usually happens is the higher lows that is forming in this downtrend. Now this is very concerning. Why? Because we broke this downtrend over here. We tried to break it over here. We tried to make it over here as well. But finally, we have this 2 to 3 week, confirmed breakout over here. So when the 10-year yield, which is the flight to safety, so that people call it as, what is the cost of capital? The cost of capital is basically the 10-year yield in which you can get, 4.6% guaranteed, as long as US doesn't default on its debt. So that is, the risk-free, risk-free rate of return. So when you have a risk-free rate of return such high as 4.6%, it makes the capital markets, that is equity markets, very less lucrative. So when you have a risk-free return of 4.6%, you will be less inclined to take risk in the equity markets. So this is very concerning. So especially when you are having an institutional investor and when you are, handling billions of dollars of funds, you would rather park a significant chunk of it in this 10-year yield or the 10-year bonds, so to speak, as opposed to equity markets, which, provides a downward pressure on equity markets. So on one hand, you have, a downward pressure from the bond market, right? And on the other hand, the cap on the upwards trend, nobody knows what it is. So this is very concerning. So I just wanted to discuss this because the capital markets are, consisting of bond markets, commodities, equities, but all of these assets are, correlated. So there is a negative correlation between bond markets and stock markets. So if you have such high lucrative returns in the bond markets, then naturally there is a very less incentive to go out and take risk in the capital markets. So I just wanted to point this out in detail because this 10-year yield, a lot of other things are dependent on this 10-year yield. So for example, you can see over here that the 30 years fixed mortgage rate, that is still sitting at 6.91%. That is almost 7%. So a lot of other things are dependent on this 10-year yield. So as long as this 10-year yield, is relatively high, this is going to put a downward pressure on the equity markets. Coming on to the second point that I wanted to discuss, that is inflation. The Fed's target is 2%. And so far, the inflation has been proven sticky, as if like it's not going down as expected or at the speed at which it was expected. So 2.7% is still way high above the Fed's target. So the inflation number, as long as it doesn't soften or as long as it doesn't come down, this gives very little room for Fed to aggressively cut the rates. So that is giving downward pressure on the stock markets and the equity markets. The third point that I wanted to discuss is the crude oil markets. So remember, one of the main reasons of inflation ratings coming down was the crude oil was constantly going down. So now, since the crude oil is again going up, that is $74 per barrel basis, that will push the upward pressure on the commodity prices, and eventually that is going to put an upward pressure on the inflation ratings. So let me show you the crude oil charts so that you can get a fair idea of what I am talking about. So if we go to the commodities and if we go to the weekly chart, so you can see over here, the crude oil, it peaked in almost 2022. And since then, it has been trading in this sideways channel and it was stabilizing around $62 to $70. But now, since the last 2-3 weeks, we have seen a rise in the crude oil prices. So if we see a rise in crude oil prices, then that eventually trickles down to all other commodities and eventually in the inflation numbers. So the very fact that crude oil is stabilizing above $70 is not a good sign for the inflation numbers, which we are going to get at the mid of this month in the form of CPI and PPI data. So we have to stay, keep a close eye on these numbers for us to know like what will be the reaction of the Fed, because Fed also takes into account all of these data while making the decisions on the monetary policy. So these kind of data points are very essential and helpful to know or gauge what will be the response from the fiscal side. So that point is very essential. Now coming to the 2025 forecast or the fate of the markets. So let's step back and let us, acknowledge the fact that we have got back-to-back more than 24% returns on an annualized basis in 2023 and 2024. So coming into 2025, it will be very difficult to, constantly sustain that level of performance. So when you already have, cashed in a lot of gains in the markets, normally these kind of phases always are followed up by the signs of digestion. So 2025, in my humble opinion, is going to be the year of digestion. It is going to be the year of sideways chop. It is going to be a year of, reflecting fundamentals. So the valuation contraction is going to take place because suddenly people will realize that the growth rate is coming down and the valuations have already hit the peak. So 2025 is going to be extremely challenging for, clocking in 10-12%, growth in the equity index level. So that is my humble opinion on the, equity markets for the year. And that is, do not expect stellar growth since we have already, had the stellar growth in last 2 years. So the last point that I wanted to discuss is the new administration and its policies. So as you all know, on January 20th, Trump is going to take the power and become the president. So there are two sides of this equation. Normally, Republican president is known for, good deregulation, pro-business government. So all that is good. And on the other side, the other policies like tariff and, trade wars and, the tighter immigration and, deporting, illegal immigrants, all of that is good on paper, but there is a cost that is involved in these kind of policies in the form of inflation. So if you have a trade war with China, if you are, fighting and deporting a lot of, illegal migrants, which is rightfully so, but there is a cost that will be paid in terms of inflation. If you manufacture everything in United States, that comes at a premium. So, eventually, I believe personally that all of these, policies and groundbreaking, decisions are for the long term, it is good for United States. But in the short term, expect a lot of chop and expect a lot of shocks as well. Maybe it's minor, but you should prepare for all of these shocks. So you'll see that on an average, the VIX will be trading higher in the era where you have instability, and once after 6 or 8 months the policy picture is clear, then you'll start seeing the gains in the equity markets. So that's my key takeaways from the macroeconomic level about the new administration, about the policies, and about the existing economic landscape of United States. So now since we have discussed all the macro updates, let us jump on to the technical analysis and see what the charts have in store for us. So thank you so much for watching this video, and I'm going to discuss all the technical analysis and charts in the next video since this video has gotten so longer. So stay tuned and keep trading, keep learning, and keep growing. Share, subscribe, and like this channel if you find real value in this. So catch you guys in the next video.